Alright folks, welcome back to Boss Economics World. Grab your strongest coffee, or maybe something a little stronger, because the simulation is glitching again. For those of you who thought the quiet part was still supposed to be quiet, I'd like to introduce you to October 11th, 2025. What a day! The President of the United States, in a move of diplomatic finesse that makes a sledgehammer look like a scalpel, decided to communicate monumental economic policy via a Truth Social post. The headline? A new, shiny 100% tariff on top of the existing ones for China, plus a ban on any and all critical software. Let's be clear about what this means. This isn't a trade negotiation. This is flipping the entire monopoly board into the air, lighting it on fire, and then billing your opponent for the property damage. We've moved from trade war to economic divorce, and it's about to get incredibly messy. So today, we're not just going to read the headlines. We're going to dissect this economic carcass layer by bloody layer, from the surface-level madness down to the tectonic plates of global power that are grinding beneath our feet. This isn't just about tariffs anymore. This is the endgame. Let's start with the immediate, brain-melting numbers. Trump's announcement slaps an additional 100% tariff on a mountain of Chinese goods. When you add that to the existing levies, many products are staring down the barrel of a 130% import tax. For the finance pros watching, you know this. For everyone else, let me translate: a 130% tariff is not a tax. It is a blockade. It is a flashing neon sign that says, do not buy this. Imagine your favorite electronics company, let's call them Pear, wants to import a $300 component for their new smartphone. After this tariff, that component now costs them $690 before it even leaves the port. Who pays for this? Let me give you a hint, it's not the Chinese government. Study after study, from the National Bureau of Economic Research to the Peterson Institute, on the last round of tariffs proved conclusively that 100% of the cost was borne by U.S. importers and, ultimately, U.S. consumers. So, congratulations, America. Your next trip to Target is about to feel a lot like a trip to a luxury boutique. Inflation, which we all thought was finally getting tamed, is about to get a booster shot of pure, uncut chaos. The markets, of course, reacted with the predictable terror of a cat seeing a vacuum cleaner for the first time. The S&P 500 tumbled 2.7%, Nasdaq 3.5%, wiping out trillions in paper wealth in a single afternoon. Your 401k just took a nosedive. Why? Because the market understands what's happening. The fundamental assumption of a globalized, just-in-time supply chain, the bedrock of corporate profitability for 40 years, is being systematically dismantled. But the tariffs are just the opening act. The real poison pill here is the threat of export controls on any and all critical software. This is the nuclear option. This is the US looking at China's burgeoning tech sector and saying, that's a nice digital economy you're building. It would be a shame if someone deleted its operating system. This isn't a hypothetical. Think about the software that underpins modern industry, electronic design automation tools from American companies like Cadence and Synopsys, which are essential for designing any advanced semiconductor. Think about industrial control systems, advanced analytics platforms, even the foundational code in cloud computing infrastructure. Cutting off this software is an attempt to sever China's technological spinal cord. It's a move so aggressive it makes the previous bans on selling chips to Huawei look like a polite suggestion. So, why is this happening now? The official line is that China sent a hostile letter threatening its own export controls. This is the classic tit-for-tat of a negotiation gone horribly wrong. It's a high-stakes game of economic chicken, where both drivers have welded their steering wheels straight and floored the accelerator. But let's peel back that first layer. This isn't just about a letter. It's about strategic choke points. Choke point number 1, China's rare earth gambit. The news mentions China threatening restrictions on rare earth minerals. Let's be crystal clear, this is China's ace in the hole. The United States Geological Survey data from 2024 shows that while China only mines about 60% of the world's rare earths, it processes nearly 90% of them. These aren't just some obscure metals. They are the secret sauce in everything that matters. The permanent magnets in an F-35 Lightning II fighter jet? They require rare earths. The motor in your Tesla or Rivian? Rare earths. The tiny, powerful components in your iPhone, your laptop, the wind turbines powering the green revolution? All of them utterly dependent on a supply chain that begins and ends in China. By threatening to cut off this supply, Beijing is reminding Washington that mutually assured destruction isn't just a nuclear concept. The US controls the world's financial plumbing, but China has its hands on the faucet for the physical materials that build the 21st century economy. When Trump talks about maybe backing down if China relents on rare earths, he's admitting, out loud, that China has found a point of exquisite leverage. Choke point number 2, the politicized soybean. Then there's the soybean saga. Why are we always talking about soybeans? Because they are not just a crop, they are a targeted political weapon. Before the first trade war, China was buying over 60% of all U.S. soybean exports, a market worth over $14 billion annually. These sales went directly into the pockets of farmers in key political states in the American Midwest, Trump's heartland. When China stopped buying, it was a precision strike on Trump's political base. The White House's response, as mentioned in the report, is to try and sell more to Vietnam and Cambodia. This is, frankly, an economic joke. In 2024, Vietnam's total global soybean imports were less than 15% of what China alone used to buy from the US. It's like losing your biggest client who buys 10,000 units a month and celebrating because you found a new customer who will buy 500. It's a band-aid on a bullet wound. This desperation highlights the asymmetry of the conflict. China, with its state-controlled economy, can absorb the pain of finding new soybean suppliers far more easily than American family farms can survive a total market collapse. Now we get to the core. This explosive event in October 2025 isn't the start of something new. It is the loud, ugly, and chaotic acceleration of a process that has been underway for years: strategic decoupling. For the last decade, the mantra in Washington and Beijing has shifted from engagement and integration to competition and containment. This isn't just rhetoric, it's policy backed by hundreds of billions of dollars. 1. The U.S. Chips and Science Act of 2022, a $280 billion package designed explicitly to reshore semiconductor manufacturing and kneecap China's ability to produce high-end chips. 2. The U.S. Inflation Reduction Act, on the surface, a climate bill. In reality, a massive industrial policy designed to build non-Chinese supply chains for electric vehicles, batteries, and green technology. 3. China's dual circulation strategy, Beijing's official policy to reorient its economy to rely more on domestic consumption and technological self-sufficiency, explicitly to make it immune to U.S. pressure. Their multi-hundred billion dollar investments in domestic semiconductor foundries like SMIC are a direct answer to the CHIPS Act. Companies got the memo long ago. Since 2018, we've seen a slow but steady exodus of manufacturing out of China, a strategy now known as China Plus One. Apple, the poster child for US-China symbiosis, has aggressively expanded iPhone production in India, which now accounts for nearly 15% of its global output, up from low single digits just a few years ago. Companies like Samsung have all but abandoned manufacturing in China for places like Vietnam. This 2025 tariff explosion is simply the moment the quiet, strategic divorce proceedings spill out into a public screaming match. And notice the escalation points. Trump isn't just talking about consumer goods anymore. He's threatening tariffs on ship-to-shore cranes. This is a brilliant, vicious, and underappreciated move. The Chinese state-owned company ZPMC controls over 70% of the global market for these massive cranes that load and unload container ships. By targeting them, the US is attacking the literal nuts and bolts of global trade infrastructure, citing national security fears that these cranes could be used for espionage. This is the weaponization of everything. It's no longer just about economic advantage. It's about turning every node of the global system, finance, technology, logistics, agriculture, infrastructure, into a potential weapon to be wielded against your rival. So, who wins in this scenario? The simple, brutal answer is, almost no one. 1. The American and global consumer, prepare for the made in everywhere else tax. Rebuilding supply chains is monumentally expensive and inefficient in the short to medium term. The disinflationary pressures that cheap Chinese manufacturing provided for 30 years are gone. Central banks will be fighting a structural, supply-side inflation that monetary policy is ill-equipped to handle. 2. Global corporations, the age of seamless, borderless operations is over. The C-suite is no longer just worried about profit margins, they're worried about which geopolitical bloc their factories are in. Geopolitical risk consultants are the new rock stars of the corporate world. The mantra is shifting from just-in-time to just-in-case. This means higher inventory costs, redundant supply chains, and lower efficiency, all of which will eat into profits and stock valuations. 3. The global south, nations in Southeast Asia, Latin America, and Africa are caught in the crossfire. On one hand, they benefit from the friendshoring trend, as Western companies move production to their shores. Vietnam, Mexico, and India are clear beneficiaries. But they are also under immense pressure to choose a side in the new tech and economic Cold War. Do you use Huawei's 5G or an American-backed alternative? Do you align your data privacy laws with the EU, the US, or China? The non-aligned movement is back, but this time it's about servers, not summits. 4. The future of the global system, this is the biggest casualty. The post-World War II, US-led order built on institutions like the WTO is being rendered obsolete. We are careening towards a bifurcated world, one economic bloc centered around the US and its democratic allies, and another centered around China, Russia, and other authoritarian states. This will likely lead to competing technology standards, separate payment systems, and ultimately, a less efficient, more volatile, and more dangerous world. What we witnessed on October 11, 2025, wasn't just another trade spat. It was a historical inflection point the moment the cold, calculated strategy of decoupling became a hot, chaotic reality. For decades, we were told a story that economic integration would lead to political moderation, that global trade was a rising tide that lifted all boats. That story is now over. The new story is one of great power competition, where national security trumps economic efficiency every single time. So what's the play? For individuals, it's understanding that the volatility you see in your portfolio is the new normal. For businesses, it's building resilience and redundancy at all costs. And for policymakers, it's facing the grim reality that the tools and assumptions of the last 40 years no longer apply. We're in uncharted territory. The era of predictable globalization is dead. Welcome to the age of geopolitical chaos.